If you could lower your mortgage payment by a couple $100, would you trade 30 years for 50? Today, we're unpacking the proposed 50-year mortgage, what it really means for affordability, equity, and risk, so you can decide with math, not marketing. My name is Fred Pascal, and for the last 20 years, I've bought, sold, built, flipped, and done just about everything when it comes to real estate. I say that so you have the comfort of knowing that anything I share with you is from tried and true decades of boots on the ground experience. You won't get this from any textbook. So the 50-year mortgage, huh? This deserves an honest look.
The stars and stripes and the eagle flies.
The idea is simple. Stretch the mortgage to 50 years so monthly payments drop and more buyers qualify. With interest rates still around 6 to 7% and home prices near record highs, affordability has taken a beating. So extending the term sounds like a clever fix. But easy fixes usually come with hidden costs. So let's run the numbers. Let's start with a $450,000 home. 10% down, 30-year fixed, about 6.25% interest rate. Payment roughly about $2,500 a month, or a 50-year at about 6.5 to 6.75%. Payment around $2,350 a month, about $150 to $200 less each month. But stretch that out for 20 more years, and you'll pay hundreds of thousands in more interest. Here's another scenario. $325,000 home, 5% down, 30-year fixed, roughly $1,950 a month. On a 50-year, about $1,820 a month. That's only $130 difference. So the math is clear. Going from 15 to 30 years changes affordability by a lot. Going from 30 to 50, tiny monthly savings, huge lifetime cost. Critics say the 50-year loan buries you in interest, and they're right, if you actually keep it that long. But the truth, most people don't. The average homeowner refinances, relocates, or sells every 7 to 8 years. Life happens, jobs change, families grow, people move. The real risk isn't staying 50 years, it's how slowly you build equity early on. On a 30-year note, your monthly payment is mostly interest for a long time. With a 50-year, it's longer. If home prices stall and you need to sell, your cushion is paper thin. You could end up being upside down in your mortgage. That's the danger. If you expect to move or refinance within 7 to 5 years, compare these three options side by side. 30-year fixed at 6.25%, about $2,500 a month. 7-year ARM, or adjustable rate mortgage, at roughly 5.5% and $2,250 a month. A 50-year at 6.75, about $2,350 a month. So the ARM can actually beat the 50-year loan. Lower payment, faster principal, shorter risk window. Just make sure you understand it and have a refinance plan written down. And by the way, this video is just my opinion. It's not financial advice. If you're considering getting a mortgage, please reach out to a lender or just ask me for a referral and I can provide that for you. Okay, back to it. A 50-year loan might make sense for a very small group of buyers. You've got solid income, tight cash flow, and plan to refi or move in 5 to 8 years. You need $150 or so in monthly breathing room to qualify safely. But if you're stretching every dollar just to make it work, or you're counting on appreciation to bail you out, this loan can trap you fast. You'll build equity slowly, and if the market turns, you could be underwater for years. In markets like Houston or anywhere homes are still rising, buyers can often do better with a 7-year ARM, adjustable rate mortgage, or an interest rate buydown, or a modestly smaller purchase price. That combination builds a safety net without trading your future for $150 a month. If Washington really wants to help buyers, there are cleaner levers than a 50-year loan. Raise the capital gains exclusion so more sellers can afford to list. Allow mortgage portability so families can carry their low-rate loan to a new home. And speed up permits and infill housing, because more supply brings real relief to buyers nationwide. That's how we fix affordability, not by turning home loans into half-century commitments. Before you sign any loan, 30, 50, or an adjustable rate mortgage, run a quick 4-gate check. Payment safety, fits your life with margin for error. Equity trajectory, look at the first 7 years of amortization. How fast are you paying down principal? Exit plan, your refi or move target, written down. And shock test. Could you survive a 2% rate jump or 12 months of flat prices? If any of those make you nervous, that's your gut doing you a favor. A 50-year mortgage isn't evil, it's just the wrong solution for most people. Small monthly relief, slow wealth building, long-term risk. If you want to own smart, build equity safely, and keep flexibility in your future, there are better tools. If you'd like a free 15-minute affordability plan, or if you're stuck with a property you need to sell as is, let's talk. No pressure, no gimmicks. Just click the link in the bio or the description. I'm Fred Pascal with Hero Homebuyers and also a believer that hope isn't a strategy. Math is. See you in the next one.